Good evening, dear colleagues. As always, it's Strelkov here, as always on a Sunday for the ForexTimes project. And as always, we will discuss the likely movement of trading instruments for the upcoming trading week. A little aside, dear colleagues, after the release of the non-farm payrolls data in the United States on Friday, we see practically the same pattern across all trading instruments. Impulse movement, impulses specifically, as I advise, primarily trading from support and resistance levels after the impulse correction and making a decision to enter the market or use the 50%, 61.8% Fibonacci retracement levels or pending stop orders. Or if we had a downward impulse, then a sell stop. So let's begin with the euro. Regarding the euro, we see, according to reports from the Commodity Futures Trading Commission, a 2% decrease in buyers. This tells us that the trend remains upward, but currently a corrective structure is developing. And let's take a closer look at this corrective structure. Most likely at this moment, right here a bit further, we have formed an initial diagonal. After the initial diagonal, we have a corrective movement in the form of a flat correction. So the initial diagonal is wave A and wave B. Why am I writing A instead of 1, 2, 3? For the simple reason that our trend is currently upward, and most likely a corrective structure is developing. So, dear colleagues, as we can see, we have an initial diagonal, and we know that an initial diagonal is an impulsive movement. Therefore, most likely in wave C, we will either see a 5-wave structure or possibly an ending diagonal. This is because both initial and ending diagonals are impulsive movements. So, dear colleagues, for trading the euro dollar in the upcoming trading week, we expect a corrective rise in the range of 50%, 61.8% Fibonacci retracement levels. We can make a decision either with pending stop orders below the base of wave C or wave A, or with pending orders. Thus, we can attempt to catch the descending impulsive movement within this large correction. Now onto gold. Gold, dear colleagues, here unfortunately the situation is developing somewhat strangely. Specifically, it's quite evident that we have formed a triangle. However, this triangle can be approached in two ways, and professionals, as you can see, cannot decide which method will be better given the levels of call and put options. Excuse me, professionals have even added some pure option contracts in quotes. So how can we approach trading gold? Let's take a look together. The first thing that immediately catches the eye is the upward movement. Why do we have some movement? Sorry, I got a bit off track. We have some movement, and there's a triangle. This triangle is like this, and after the continuation of the instrument's rise, since the triangle is the penultimate wave, after this rise, we can expect a very strong corrective decline. Alternatively, if we are dealing with option contracts, gold can be traded as follows. The triangle may be descending with waves A, B, C, D. Wave E has not yet formed, and it's not even visible or audible at this point. And after that, the downward movement again. Since the triangle is the penultimate wave, we reverse to the downside after a significant rise. What I like most here is that if wave E forms here, after that we see a rise either in wave D. After that, we see a corrective rise towards wave E and then a decline. In any case, it seems to me that we will see a downward movement towards the market maker's loss level, specifically at the $244 level. So, dear colleagues, if anyone is feeling eager, you can certainly try to trade this level, especially since it's a minimum of 250 points, maybe even 260. But if you're not itching to do so, and you want to approach it strategically, I suggest, first of all, assuming that we'll see a sharp rise, you can place a pending order above wave D, hoping that after the formation of wave E, we'll witness a sharp rise and you can take profits. If, however, this rise doesn't occur and we see a corrective movement instead, then most likely we have wave D and wave E here. This means you can place a pending order for selling below the point, hoping for a profit when it moves down. That's how you can approach trading gold for the upcoming trading week. In my opinion, it might not be entirely correct to chase those 250 points towards the market maker's loss level. Dear colleagues, today, once again, I'll focus on the Dow Jones index and the SP500 index. I still firmly believe that something should happen in America. Specifically, let's look at it from the perspective of the S&P 500 index. These are weekly options contracts on the S&P 500 index that professionals use to hedge their futures deals. Here we have contracts for sale, and I'll show you the options contracts. These are weekly options contracts, and I'll show you the T contracts where professionals want to buy. So, dear colleagues, here we see 95 billion, 234 million, 164 million, 262 million, and so on options contracts in volume. If I were to theoretically calculate all these contracts, I think it would add up to quite an impressive sum. Now, let me show you what's happening below. This is an impressive amount, dear colleagues. Look at what's going on here. If I were to calculate all these options contracts, I've calculated over $100 billion. $100 billion, imagine that. Idiot investors who sit and think, let's just throw 100 billion of our money into the market over the course of 2 months. Why would we need these $100 billion? It's nonsense, dear colleagues. I believe that the professionals on the Chicago Mercantile Exchange know something, they evaluate something, they understand something. There are options contracts here worth 100 billion. Let's shrink the charts to see it differently. Here you can see professionals who are thinking about the rise of the S&P 500 index. And here you have professionals who are betting on its decline. Here it's 10 billion and here it's 100 billion. I believe that something should happen in the American stock market. And when we talk about the S&P 500 index and the Dow Jones index, they generally have a positive correlation. If the S&P 500 index falls, then the Dow Jones index falls too. Why is the S&P 500 index currently rising? The reason is that I have looked at the financial reports of the largest companies in this index, specifically the Magnificent Seven. These are the 7 largest companies whose financial reports have been even better than expected, but I didn't just look at them. I also examined around 25, 30 mid-cap companies. I can tell you that things are not very good there, and some companies are doing very poorly. However, the S&P 500 index survives, thanks to this Magnificent Seven, the 7 companies that are driving this index upwards. But there's a principle called domino effect. If companies in the S&P 500 index start to fall, and remember there are 500 of them, so while we are talking about just the Magnificent Seven, there are actually 500 companies in there. If 200, 250, 300 companies in this index start to decline, I think they will drag the index down no matter how much the Magnificent Seven try to prop it up. As soon as the S&P 500 index starts to go down, we will undoubtedly see a significant decline in the Dow Jones index as well. Sorry, haters, but we will see the level of 31,000, and we will reach it. Thank you very much, dear colleagues. This was Strelkov from the ForexTimes project. Please come to the community ForexTimes. You won't regret it. We provide forecasts for more than 10 trading instruments based on both Chicago Mercantile Exchange data and Ralph Elliott's wave theory. Starting next trading week, we will begin publishing signals for all these forecasts. In a month, I think we will have between 12 to 15 trading signals. Please join us. Let's make money together. This was Strelkov. Goodbye for now.